Back in 2021, Wall Street had this shiny new thing for everyday investors. It was called a SPAC, a blank check company that basically promised to go out and find the next big unicorn. It was sold as this amazing democratization of finance, a way for the little guy to finally get in on the ground floor. So how did that beautiful promise turn into an absolute trillion-dollar nightmare? Let's get into it. To get a sense of just how bad the collapse was, you just have to look at this number. The main index that tracks these companies after they went public, it plunged over 80% from its peak. I mean, this wasn't just a dip. It was a complete and total wipeout. And hey, don't just take my word for it. One of the key articles we reviewed for this explainer called it exactly that, the greatest wealth destruction event of 2021. That financial dream, it turned into a really devastating loss, especially for a new generation of investors. And what did it leave behind? Well, a corporate graveyard. We're talking dozens of bankruptcies and literally hundreds of what they call zombie companies just trading for pennies. That whole grand idea of democratizing finance, turns out it was more of a sophisticated wealth transfer, and not in the direction anyone hoped. So this is the big question, right? How in the world did we get here? How did this exciting new tool, this blank check that was so full of promise, end up paving a road straight to ruin for so many people? To figure that out, we've got to go back to the beginning. All right, let's rewind the clock to the absolute mania of 2021. In this section, we're going to try to understand the dream, the hype, and exactly why everyone, from A-list celebrities to regular retail traders, got completely swept up in the frenzy. Okay, so first things first, what even is a SPAC? It's actually pretty simple. It's a shell company. It has no real business operations. The pitch is basically, hey, give us your money at $10 a share, trust us, and we'll go find some brilliant private company and take it public for you. Think of it like a shortcut to the stock market. And in 2021, the market just went wild. As you can see here, 613 new SPACs were created, and they raised an unbelievable $162 billion. To put that in perspective for you, that is more money than the entire SPAC market raised in the decade before it combined. It was, without a doubt, a full-blown mania. And this chart really shows you why they got so popular. A traditional IPO, it's slow, it's expensive, it's heavily regulated. A SPAC, on the other hand, was like a fast track to the public markets. And here's the real kicker. Companies that merged with SPACs could make these incredibly wild, optimistic financial projections about the future that would be absolutely forbidden in a normal IPO. And you have to remember, all of this was happening during a very unique cultural moment. You had people with stimulus checks, a stonks-only-go-up attitude coming from places like Wall Street Bets, and tons of retail investors just piling in, buying up these dreams of flying cars and hydrogen trucks. But here is where that dream starts to get a little bit sour. Let's move on and see how this whole game was kind of tilted from the very beginning with these built-in flaws that made massive losses almost inevitable for the average person. The spectacular failure of this whole model really boils down to three core structural problems. Let's just call them the founder promote, the pipe trap, and the redemption spiral. When you put them all together, they created a machine that was fantastic for insiders, but pretty terrible for long-term shareholders. Okay, let's start with flaw number one, the founder promote. The folks who started the SPAC, the sponsors, they got a massive 20% chunk of the company's stock for a ridiculously tiny investment, sometimes as little as 25 grand. This meant they could make millions of dollars, even if the stock completely tanked after the merger. So their incentive wasn't to find a good deal, it was to get any deal done before their time ran out. Now, these next two flaws, they kind of work together as a 1-2 punch to drain cash out of these companies. First, you have the pipe trap. Big institutional investors, they got these sweetheart deals that let them invest on better terms and often cash out early to lock in their profits. And then you had the redemption spiral. See, as the hype died down, regular investors could pull their $10 a share out before a merger even happened. This redemption meant that by the time the company actually went public, it was often starved for cash with no money left to actually run the business. So all those structural flaws, they ended up creating some pretty spectacular real-world disasters. Let's head over to our next section, which we're calling the Hall of Shame, and see how this all played out with some of the biggest names from the SPAC boom. And the amount of damage was just immense. By 2023 alone, these bankruptcies had vaporized at least $46 billion in equity value. Just let that number sink in. Now, let's meet some of the companies behind those losses. First up, Lordstown Motors. This electric truck company was at one point valued at $5 billion. But then, it came out that they had allegedly faked their pre-orders to gin up hype. The company eventually filed for bankruptcy in 2023. Then there was Virgin Orbit, Richard Branson's satellite company. It went public through a SPAC and was valued at $3.7 billion. But after a very high-profile launch failure, it just couldn't secure any more funding and filed for bankruptcy less than 2 years later. And hey, remember WeWork? After their first IPO attempt famously blew up, they used a SPAC to quietly go public. But the old problems? They didn't just disappear. Weighed down by massive debt, this zombie from the start also filed for bankruptcy in late 2023. And of course, there was Nikola Corporation. This is the one where the founder was actually convicted of fraud after a promotional video was exposed as a complete fake. The hydrogen truck wasn't driving under its own power. It was literally just rolling down a hill. You can't make this stuff up. So, after all that carnage, what happens now? In our final section, let's take a look at the aftermath, the regulatory response, and the very, very expensive lesson that the market learned from this whole mess. This timeline really tells the whole story, doesn't it? You see the absolute mania of 2021, the inevitable wave of bankruptcies that came right after, and then finally, in 2024, you see the SEC stepping in with new rules designed to hold sponsors and companies a bit more accountable. Now, the market hasn't totally vanished, but it has changed a lot. Some people are now calling it SPAC 4.0. It's a much smaller, more sober, and way more disciplined environment. The celebrity sponsors and the crazy promises, yeah, they're mostly gone. So after digging through this incredible boom and bust, what is the single most important lesson here? What's the one thing we should all remember the next time Wall Street comes around with a can't-miss opportunity? So what's the takeaway? I think one of the sources we reviewed puts it just perfectly. A lesson that cost investors billions, and one that's definitely worth remembering. When Wall Street offers you a blank check, they are usually the ones cashing it. A powerful and very expensive final thought.